Levels of support, candlestick lows that the bears must contend with to make lower lows or to continue to have the position move in their favor. And when trying to penetrate each level, the market may experience opposing buying pressure. Here, price moves down, clearly establishes a level of support, some nice candlestick formations denoting this level of support. Price retraces somewhat, and then the market makes another go at this previous level of support, clearly acknowledged by the market, and is rejected. And once the market decides it's not going to go below this low, often we see the flows in the bank when they are dealing and they are trying to price in a future event or trying to create new price levels for a specific currency cross. If they realize that they are unable to penetrate these levels, then quite often the flows make a complete shift, and they will completely move then in the other direction. So there will be a release of the selling pressure and or a lightening up of selling pressure, and often it can be converted into buying, and we see a move like this very, very often. If the current market price is here and we have on this 60-minute chart, we have our distinct levels of support, then these are clearly levels that the market will have to contend with at some future date in order to continue in the bearish direction, as these are primary reference points to the market. Now, these lows are, when you're dealing at an interbank level, you know the price points at which you have previously traded or at which flows have changed in price within the last the short term, the medium term, and the long term. And looking at the short term, this is a price point that would be held very distinctly in the minds of the traders and as a very distinct reference point. Therefore, if price starts to move down towards these lows, you will see the market bounce or price bounce at these levels. And you may see it sometimes in your trading account where you see the price is bouncing and moving, and all of a sudden it moves 10, 15, 20 pips against your position. Well, quite often it's a result of a distinct level of support or resistance that the market is respecting. It's important that you read the dialogue within the pages of your manual after we're done the session, just as a reminder and as a summary of what is contained in that slide. As we continue on, just read through this. What I want to show you here is that this is a daily chart, and we've got about 8 months of data on this daily chart. And we can see here that for example, there's a very distinct low that was formed here, and it being on a daily chart, we want to watch price closely, as we see traders had watched price very closely, and price failed to move below this low, and look what happened. Price rallied 800 pips to to this high point up here. And we see some interim swings here, low point, a high point, a low, a high. But here we've just pointed out the major lows, major key levels of support, and major levels of resistance. Therefore, if the market price is here and we start to move lower, absolutely, because this is a daily chart, you absolutely must observe this low point, because a very good trading opportunity could present itself right here at this low, as we saw down here. By the way, these are not trend lines or any kind of fancy indicator. These are just lines noting the lows and the highs. Now we're moving down to a 60-minute chart. So we see it's a more microscopic view or a more magnified view of what's happening in the market. Here we see a low, a high, a low. We're making higher highs and higher lows, and we've just noted the price swings within the bigger price swings. Very clearly defined levels of support that the market will have to contend with if you are a bear, and this only covers, whereas on the daily chart we saw 8 months of data being covered, here we see only 8 days of data being covered. Data meaning price action for a period of 8 days. Now we'll narrow it down to even a smaller time frame, which is a 15-minute chart. And here we see you see this date right here. This is the previous day, this is the current day, and so we only have roughly a day, 1 to 2 days of data or of price action on this chart, as each candlestick represents 15 minutes of time. So we see our price swings on this time frame, and what I want you to look at here is you see this level of resistance, you see how it met resistance and fell, and this in and of itself is a payable trade. It comes back again, tests resistance, and falls. Now what's important here is I don't want you to just look at this as resistance. You have to think about it in terms of what's going through the minds of traders, and as 100 million, 500 million, $1 billion, and $2 billion is flowing through their desks, that these are primary reference points that the market is observing, and if they start to move above these reference points, that their environment is now changed relative to the hundreds of millions of dollars that they're trading, and their environment could change in terms of accumulating loss scenarios or profit scenarios, or simply dealing in exchange scenarios. Therefore, these prices are very important to the contributors of the major flows to the market, and that's the way you have to look at it, not just as a technical level of resistance, but as a distinct trading reference point for the major flows. And please note this, folks, because this is going to be invaluable to your discretion in viewing the market.